Hi, my name is Jonathan Lopez. I'm the president of Golden 15, where we teach value investing principles of Benjamin Graham, who was the author of two great books. The first one, The Intelligent Investor, which Warren Buffett called by far the best book on investing ever written, and then Security Analysis, which really became the textbook for the investment security management industry. So, for more information, you can go to www.goldenxv.com. So what we want to talk about today was Graham's definition of quality blue chip companies. And to just take a step back, when we talked about the Graham's definition of an investment, one of the components of that was safety of principal. And one of the ways that we get safety of principal is by investing in quality blue chip companies. So what specifically does he mean by a quality blue chip company? Well, Graham says a company that would meet that characteristic would have 5 characteristics. Number 1, it would be large. Number 2, prominent. Number 3, conservatively financed. Number 4, good credit and solid earnings. Those are the 5 characteristics of a blue chip company. Those are very good characteristics to have, and we'll talk about that in a little bit, why that's so important. But if my daughter were to bring over a young man to the house for dinner, and this young man were tall, he were prominent, conservatively financed, with good credit and solid earnings, I'd say, son, welcome to the family. Because those are very good characteristics to have. So for investing purposes, why would it be important for a company to be large? Well, a large company would tend to have the resources in terms of capital and in terms of human capital and other capital to withstand some type of temporary downturn, and also the market would tend to respond well to any improvements in their condition. So that's why it would be good to invest in large companies. Then he says prominent. Why would it be important for a company to be prominent? Well, if a company is a leader in its industry, it probably got there because of some combination of superior management, superior products, or superior service, and it's beaten the competition. It's shown a track record of having been better than the competition. So that would be a good company that we may want to invest in. The third one is conservatively financed, and what we want to look at is we're looking at their balance sheet, and we want to see that they have a strong balance sheet, and in particular very low debt. We don't want a company that has a lot of leverage on their books, because that tends to get companies and countries, as we have seen in the news recently, in trouble. So we want to stay away from those highly leveraged companies. So the fourth one is good credit. We want a company that shows a history of paying their creditors. Why is that important? Because we're going to be one of their creditors, and we want to get our money back. So we want to make sure that they pay people like us. And then the last one is solid earnings. We only want to invest in companies that make money, not in companies that are losing money, and obviously, because if they have earnings, then they have a means of paying us back, and that's what we want. So let's go a little bit more in depth in those 5 characteristics, which once again are large, prominent, conservatively financed, with good credit and solid earnings. So what specifically is a large company? And the number we're going to use there is a market capitalization of 10 billion or more. That's going to be our definition of a large company. How about prominent? What we're looking for there is specifically a company that is in the top 25% of its peers ranked by market cap. So one of the leaders in its industry would mean top 25% of its peers by market cap. Conservatively financed. How are we going to define a company that is conservatively financed? Well, first of all, we're going to say their book value to total capitalization should be at least 50%. Okay, now we're going to get a little bit technical here, and I want to explain that. We threw out 2 words, book value and total capitalization. What does that mean? Well, the total capitalization is the way that a company is capitalized or financed. Okay, and there's 2 ways basically to pay for something: with your own money and with other people's money. Right? If you were to buy a house, let's say a $300,000 house, let's say, and you put 10% down, you put $30,000 down, And then what would you do? You'd go to the bank and you'd get some money from them. You get $270,000 from them as a loan. And so you could say that that $300,000 is the total capitalization. Okay, and how was that capitalized? $30,000 was equity or cash, and $270,000 was debt. Okay, so another word for equity could be book value. Okay, so what Graham says is what we want is a conservatively financed company where their book value, right here, to their total capitalization is at least 50%. So that means we want them to have at least 50% of their own money in this, of their own equity, or 50% down, if you will. Minimum 50%. And imagine if the banks only lent to borrowers who had 50% book value to total capitalization, or 50% down payment on a house. They'd be in a very strong position, wouldn't they? Okay, so that's one of the characteristics of a conservatively financed company. Book value to total capitalization, at least 50%. The second thing he's going to say is their coverage should be at least 5 times. What does that mean? Coverage is the number of times that their interest expense is covered by their earnings. Let me give you an example. Going back to this house thing. So this person went to the bank for a $270,000 loan, and let's say that loan, the payment on that, or the interest expense was $2,000. Okay, that was their interest expense, $2,000. Now what if their income was $3,000? As a bank, how would you feel in that position? That they have this interest expense or this house payment of $2,000 and their income is only $3,000. You might be a little concerned because are they going to have enough money to pay all their bills, including their payment to you? Maybe, maybe not. But what if their income was, say, $10,000? Okay, $10,000, and their payment was $2,000. Would you feel a little bit better on the ability to get your money back if you were the bank? And I would probably say yes. And that right there, 10,000 over 2,000 is 5 times. That would be 5 times coverage. And that's what we're looking for. We're looking for a conservatively financed company would have book value total capitalization at least 50% and coverage of at least 5 times. Okay? So a large company is 10 billion or more in market cap. Prominent is the top 25% in industry. Conservatively financed is book value total capitalization over 50% and coverage of 5 times. The next one is good credit. Large prominence for finance with good credit. Good credit, the way Graham is going to define a company with good credit is a company that has a consistent history of dividend payments for 20 years or more. Why does that mean that a company has good credit? Well, securities law states that if you're going to pay a dividend, you have to pay all your other creditors first. Okay, why is that? Because when a company pays a dividend, what are they doing? They're paying their shareholders, or in effect, they're paying their owners. In effect, the owners are taking money out of the company when they receive a dividend. And the government says, or the securities industry says, that's okay as long as you pay all your other debts first. So a company that has paid a dividend for 20 years or more, by definition, has paid all its other bills for 20 years or more. They've paid all their bondholders, they've paid all their preferred stockholders, they've paid all their other liabilities, because they cannot pay a dividend until after they've paid all those other liabilities. So a company that has paid dividends for 20 years has good credit. Actually have excellent credit. Okay, and then the last one is solid earnings. We want a company that over the last 10 years has had positive earnings, and that over the last 10 years their earnings have generally been growing, at least 3% a year. Think about it for a second. If I were a bank and I wanted to lend to someone and they were very conservatively financed. They came in with 50% down payment. They had 5 times coverage on their house payment. So that was no more than, say, a 20% debt to income. They had good credit. I ran their credit score. In the last 20 years, they never missed a single payment to any of their creditors. And they had solid earnings. They've had a job for 10 years, and their earnings have been going up a little bit every year. I'd feel like I was in a pretty good position. And as an investor, if I bought a company like that, I'd also feel that I had found a good quality company. So that summarizes the 5 characteristics of a quality blue chip company.